Basically, Chris, we're going from a world of building wealth to protecting it in an energy scarcity world. And you can really only do that mostly in precious metals.
Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics as we continue our coverage in the silver world. And quite fortunate today to be joined by Steve St. Angelo of SRS Rocco, who's been looking at silver and the metals for quite a long time, has also been connecting some of the energy dynamics that are taking a more prominent role, certainly with everything that's going on in the world right now. Seeing a lot of tension in the energy markets, certainly as Russia is pulling back. So a lot to dig into today. And Steve, great to have you back on the show. It's probably been too long, but good to have you here today. And how's everything going with you?
Well, Chris, it's great to be here. Thanks for inviting me. And the one thing I'd like to get across to your listeners is why it's important to be in the precious metals. And what I used to think the reasons to be invested in the precious metals has changed, and it really has to do with the energy. So I'm glad to be able to share some of this information with your listeners.
Well, I appreciate that, and perhaps that's a good place to start because I know you were mentioning it's been about 20 years since you bought your first ounce of silver, maybe around the $4 or $5 level, and
right,
sitting around $19 today as we record on Monday, October 17th. So what is it that has changed, especially as we're updating the energy dynamics? What is it that you're seeing now that you look at differently in terms of silver and the reasons why it's valuable for people to be looking at silver as an asset class?
Well, thanks to Ted Butler, when he was writing, he's been writing about silver, the silver market for two plus decades. And so when I came across his information back in the late 90s, early 2000, I said, gosh, this is a good idea to get into silver. So I bought my first couple of 100-ounce bars for $4.52 an ounce, just like you said. And I did it for the same reasons that most precious metal investors and analysts say the reason to be in gold and silver. And that's, debasement of the currency, that's all the debt that's being printed, all the money, supposed money printing, all the derivatives, or the loss of faith in the currency. So these are the reasons, and then we can throw in geopolitics, right? These are all the main reasons that we get into the metals. But the one factor I found out that's actually the most important has to do with energy, because we burn a lot of energy to run this world and to produce all the goods. Matter of fact, the global economy is nothing but burning energy to produce goods and services. So if you grow energy production, you can grow what the goods and services are. And this is the same thing. You go back to the late Bronze Age and the ancient Roman Empire. They cut down hundreds of millions of trees to make charcoal, to smelt metals. And that's how they advanced their civilizations. And this all changed in the 1700s when England figured out how to use coal to smelt iron. And then our population really took off. And so now energy is really the key factor to own the precious metals. And I said, why? Because we're heading into a world I call the energy cliff or energy scarcity. And I could talk a little bit about that. But in a nutshell, stocks, bonds, and real estate, that's mostly where the investors are. 99% of investors are invested in some form of stocks, bonds, and real estate. And a very small percentage, less than 1%, are invested in gold and silver. The problem is the increase in energy production and increase in the world economy has allowed investors to gain wealth in stocks, bonds, and real estate, but that all starts to fall apart when energy production declines. And it really falls apart. But what holds its value, and it will increase, are the metals, because they will become a store of energy value like they have been for 2,500 years. And as more investors wake up that they're not really holding on to, basically, Chris, we're going from a world of building wealth to protecting it in an energy scarcity world. And you can really only do that mostly in precious metals. And I can kind of explain why that's the case.
Yeah, because if you could dig into that, I think that'd be helpful. I had a note here where, as you just mentioned, you look at gold and silver as a store of energy, and perhaps you could elaborate on that and exactly what you mean there.
Well, I used to say that. I used to say gold and silver are a store of energy, and they're not. They're not a battery. Well, what they do, it takes so much energy, not only today, but it took a lot of energy 2,000 years ago to produce gold and silver, a lot of energy. And so what this represented, the coin kind of stored this energy value, which is the foundation of all economies. Doesn't matter if it's the ancient Roman Empire or the British Empire, or now the modern high-tech global economy. Money, which is the metals, is supposed to store energy value. And right now it costs about $1,500 to produce an ounce of gold. And if you look at the entire process to produce gold in all forms and stages, I would say that $1,500 right now, about 95% is energy in all forms and stages. That's what it costs to produce that. So it's storing this energy value. And so that's the reason the price of the metals are kind of based on this cost of production, because most goods in the world that we buy are based upon how much it costs to produce it, transport it, and then put it in a store. And then then there's a little bit of a margin, what they can make a profit on. And so it's the same thing with gold and silver. The only difference is when energy production declines, Chris, the stock that is based on earnings and the bond that is 10-year, 20-year, 30-year bond that's based on growing economic activity, and that real estate that's based on a 30-year mortgage, well, when energy production declines, all those assets start to lose value, they implode. And so this is the market has been kind of hoodwinked into believing that stocks, bonds, and real estate are the place to be. And they have been, because we've increased in energy production. But now that that's peaking and we're seeing, the disaster in Europe, that's just the beginning. And as this disaster, this energy disaster crisis spreads throughout the world, more and more investors are going to be forced. And I say that they're going to be forced to move into metals to protect their wealth, because those other assets won't do it.
Yeah, and I know you mentioned that we're reaching the point where we've kind of hit the peak energy and starting to decline, just in terms of how much oil we're consuming and what would be needed to replace that. Have we finally crossed that turning point, and now there's just not out there to be found in the amounts that would be required to keep growing at the same rate?
In a nutshell, that's correct. And, the theory of peak oil, those who think peak oil is a conspiracy, they say that the peak oilers, they said peak oil was here and then it didn't come. And I mentioned to you in the pre-interview that the brains behind the peak oil movement said that the U.S. was going to peak in 1970 conventional, and we did. And that was N. King Hubbard. And then he predicted global peak was going to happen around 2000. And then Ken DeFrays, he suggested it'd be 2005. And these are the real bright minds behind the peak oils. Well, there's no coincidence that the price of oil hit 145 in 2007-8, because we hit the peak of conventional. And then as the Fed dropped interest rates to zero and did massive QE, the U.S. shale industry came on, and actually since the financial crisis in 2008, the global oil production growth, 80% came from shale oil. And that was based on QE, zero interest rates, and a massive amount of debt. So the world got another 10, 15 years keeping the lights on, because we brought on a very low energy return on investment oil. So people think because we did that, we can continue to do that. The problem is this: the U.S. shale industry loses 45% of its oil production every year. And they have to make that up next year and the year before. Well, they were able to grow production because they ramped up all 100,000 drilling locations. But these are not unlimited. They're limited. And now they're getting ready to peak and decline. So it's going to be a boom and a bust. And when we realize that the world growth came from shale, and now, and I mentioned this to you, in 1960, the world was producing about 30 million barrels of oil a day. And we're losing about 2 million to the natural decline rate. Today, we're producing almost 100 million, and we're losing between 10 and 12 million barrels a day. That means the world has got to find a new Russia every year. Every year, from to this year to next year. And this is where the rubber hits the road. And so now, unfortunately, it doesn't matter how much money we throw at it. People say, well, we're just not investing enough. Okay, let's say we did a Manhattan project and invested gobs of money. Sure, we may get a little bit more growth, another few more years, but the collapse is going to be even more breathtaking. Because, and this is the issue we're really facing, because if you continue to add higher growth, the decline rate is going to be, it'll go from 10 to 12 to 13 to 14. And you cannot continue to replace that. And so it's called the Red Queen syndrome. We're running faster and faster and faster now just to stay in the same place.
And so is it just a matter of, as that decline continues, that we see the price of energy rise, and that is tying it back to silver, what is going to necessarily have to drive the cost of production and thereby the actual price of the metal up itself? I mean, actually, a couple of factors there, but is that what you see as the primary driving one?
Actually, not the primary driving one, but that is probably going to be one of the factors, right? Because if you look, I've got a 50-year chart, and you know, it's funny. People say, well, a lot of the manipulation of the metals, gold and silver, started when they started doing futures trading in the 1970s. Why? Because that's when the CME and we had the COMEX and we started trading gold and silver futures. Well, so this was supposed to keep the price of gold and silver going up. Well, it didn't, because the price of silver was like $1 something, and then it went to 50, and the price of gold was 40 and went to 850. So somehow doing futures didn't stop, you know, the huge increase in the price. The issue is, the reason why the metals went up that much in the 70s was because the price of oil went up from $1.80 to $36. And Homestake Mining, who was the largest gold producer, and they also had some silver mines, the cost to produce gold and silver for them exploded. Well, if they're going to sell gold and silver, they can't sell it like $40 back in 1970. Their costs exploded. So the issue is, when the prices really hit a high in 1980, traders and the market tends to overshoot. And Homestake was making serious profits, 50% profits. Well, the markets began to realize this, and that's when the price came back down again. And so when you look at when did the price of gold and silver kind of bottom in the last 50 years, they tend to bottom when the oil price bottoms. They bottomed in 2008 when the price of oil went from 145 down to 30. They bottomed in 2016 when the price of oil went from $100 in 2014 down to 30. And so now a lot of the problem is, or a lot of the price action of the metals is based on energy, because that's what it costs to produce it. And in investment demand or demand. But now, going in the future, I say, Chris, even though the price, the higher energy cost, higher production cost, that's going to be a small factor. The major factor is investors trying to access physical silver or silver in the market, and there just isn't that much silver. So it's going to be less to do with the production cost, which has been the main driver, and demand. It's going to be the huge increase of demand by investors to protect wealth. That's going to be the major driver, not industrial demand, but investment demand.
Yeah, and it seems like we've started to see that a little bit already, again, in your video, and we've talked about it a bunch on the channel. We've seen the COMEX registered inventory going down, the LBMA vault holdings going down, and especially in the last couple of weeks, as I've talked with different bullion dealers, premiums going up. People are still buying a lot of metals. And also interesting because some of these dealers have mentioned that the wholesalers, a lot of the products they're told now check back in 2023, mid-November. Some stuff just isn't available. To be clear, that's not that there is not silver outright available, but certainly had several dealers tell me that they're seeing conditions of certain products, and the inventory on the wholesale level is changing. So it seems like we're starting to see that now.
Yes, well, you see, I'm glad you brought this subject matter up because I want to explain there are two different markets, and maybe you've heard me explain this, and so I want to clarify. The reason the ETFs came into the picture, a lot of the precious metal community say that was to manipulate the price. Actually, I think it was different. I think it was there to allow the institutions, which are the main drivers of price in the market. Institutions control most of the assets in the market. So it gave the institutions a way to get into gold and silver. And so now you look at the gold and silver ETFs. Matter of fact, this is where most of the gold and silver is stored in the world. It's not on the exchanges, the futures exchanges. And I made this case that there may be 380 million ounces of silver on the COMEX registered, on the Shanghai Futures Exchange, and then on the LBMA other. And when I say LBMA other, that's silver that's not set aside for the ETFs, right, whether it's the iShares SLV or the European silver ETFs, Deutsche Bank, and these other ETFs. And so when you realize there's twice as much silver in these ETFs than there is on the exchanges, especially the COMEX, right? There's 40 million ounces. The COMEX is becoming less relevant. It will become even more less relevant as time goes on. And so what's happening is that the institutions right now are looking at what the Fed and central banks are doing and what they think, because they look at the markets differently. They think that we're going to head in towards a recession because, by God, the Fed's going to continue to increase interest rates, and they're really going to try to hurt the economy. And that's not good for energy prices, and that's not good for metals. So these institutions that are run by rocket scientists who do all these algorithms and derivatives products and all these things, they're lessening and easing up on their silver and gold exposure, which we're seeing outflows of metal out of these ETFs. On the other hand, you've got the diehard precious metal investors and more regular investors that are waking up to the problems they see, and they're moving in more towards in the bullion. And that's why we're having a lot of demand with lower prices and much higher premiums. And I think that's just going to get worse. But to me, the real price action, Chris, is going to take place when the institutions, high net worth individuals, and hedge funds understand why they need to be in physical metal. And that's when we're going to see both markets, the institutional market and the bullion market, really move. And then even I think the institutional market is going to try to actually get silver, physical silver too. Some of the wiser institutions want to get their own silver or gold, store it outside the system. This is when I see the market for precious metals really turn around. And that may be a little bit down the road, but that's coming because of the problems we're having with energy.
Yeah, which actually was my next question in terms of what do you think is the driver for that? I know in your presentation you mentioned that it's becoming harder and harder to service the debt costs, especially as interest rates are rising. And at some point, with all the debt that's out there, you run into a problem. Is that what you see as the driver that finally changes that dynamic that many of us have been expecting for a long time and perhaps somewhat underway, but not fully yet? Is that what is the turning point in your mind?
Chris, yes, precisely. And I hear from many analysts that we're heading to the stagflation of the 80s, right? The 70s and 80s. But this is a much different world. And the term "this time is different" is true, because in the 80s, we had 4 decades of global oil production growth. In the 1980s, we didn't have the 300 trillion of debt the world is now choking on. So you could raise interest rates to 12, 14, 15% because you didn't have the debt. Yeah. Now that we're doing that, we're destroying countries all over the world. And we saw that a few weeks ago with the problem with the UK currency, the British pound, and the gilt market went into a hemorrhage. And that's just the beginning stages of what's happening. So, and then there's all the derivatives and interest rate swaps. The market has hundreds of trillions of interest rate swaps trying to figure out how to keep business going, because you know what interest rates are supposed to provide the market with the return. You see, we want a return on our investments. That's what we want. Pensions want 6 to 7% return every year. If they don't get that, the pension system starts to get into trouble. Well, the only way you can get return on investment is if you have oil production growth, because this return on investment doesn't come out of thin air. It comes from increasing economic activity in the world. The only way you can do that is by increasing energy production. Well, when energy production starts to peak and decline, all this debt, all these investments or supposed investments, I actually call them liabilities or a Ponzi scheme, it becomes exponentially hard to prop them up. Because I said this before, if you're going to print money, increase debt, and do all these things to keep the system going, you can get away with it if you have energy production increase like we've had since the financial crisis. But if you don't have the energy to back it up, the increase, you look like Venezuela. And that's hyperinflation. And look at Zimbabwe. This is what's hilarious. They're going to keep interest rates at 200% to keep a stable economic environment. How the hell do you have a stable economic environment with 200% interest rate? And so what's happening in Zimbabwe is going to start happening in a lot of third world countries. And I call it the Pac-Man. And they're going to do the same thing Zimbabwe is doing just to try to keep the lights on and keep things going. And it's going to work up the chain. And eventually we're going to see inflation, serious inflation, hyperinflation hit the bigger economies, the Western world. But that's going to take a bit of time, but we're already seeing what's happening in Europe. And again, this is just a preview of what's going to spread throughout the rest of the world.
Yeah, I hear you. In fact, this came out on Friday. U.S. Treasury asked major banks if it should buy back bonds, so perhaps not all that far off in some senses. Although, Steve, last thing I wanted to run by you today is this other chart you had up here in terms of the potential downside of silver. And you showed that, for the most part, usually doesn't go too far below the cost of production. Again, with silver, a lot of the silver is coming as a byproduct from non-primary silver miners. But what have you found in terms of how much of a floor the cost of production actually acts as in terms of the silver price?
Good question. And I have 2 ways to answer that. First of all, I didn't make up this chart. I just did the analysis to figure out where the cost of production was for the primary silver miners. And so when you see the cost and when the price came down, I didn't make that up. I just went and looked at what the primary miners, their break even was, and this is what the data showed me. And so it was interesting that when we had these big sell-offs in the silver price, they tended to bottom on the cost of production. Now, silver is a little bit more volatile, and like you said, 55% of silver comes from base metal mining, copper, lead, zinc, and 15% comes from gold. So it's just not the primary silver miners. And some people say, well, Steve, it's only 28, 30% from primary silver miners. So that chart shouldn't really work. Well, it is working because that's what the chart shows. The thing is, if we look at base metal miners and people think, well, the base metal miners, they have byproduct silver. And I mentioned this, that KGM Polska in Poland is one of the largest silver producers in the world. And because they produce a lot of copper, their byproduct is silver. Well, right now, with the high price of energy in Europe, they're barely breaking even now with copper. So they're not giving their silver away for free. And that people we need to understand, these base metal miners don't give away their byproduct credits for free. They use them to remain profitable or to have profits. So without that silver revenue, KGM Polska would be losing money. So even though the primary silver miners cost that I show you in this chart is based on the primary silver miners, it's actually true also for the base metal miners because they tend to run in a similar parallel in cost of production with all metals industries, typically. And so is this time different? Are we going to see, some people are calling for $15 silver, 14. Well, you never know look at the oil price, right? The oil price in 2020 went down to negative for a brief period. We could see a volatile move. Well, I don't believe we're going to see a sustained low price in silver. Why? Because the commercial banks, their net short position proves to us that's the case. And this is how I look at it, and I don't mean to go on too much longer here. When we see a low in the commercial net short position, and that's the bullion banks who buy a lot of the metal, they have longs and shorts, and when these become even or a very low net short position, well, you know what? That tends to be very close to the cost of production because again, they've got these rocket scientists running their different departments, and they kind of understand this. So yes, even though we've seen a lower oil price, it's probably now $18.5, $19 to produce silver. But if oil prices turn around, and I think we may see higher oil prices, especially if OPEC starts cutting 1 to 2 million barrels a day, on top of the White House not selling any more SPR oil, which was almost 1 million barrels a day for months, we could see the oil price shoot back up to above 100. And what is that going to do? That's going to push the cost of production back up. So we need to continue to look at the oil price. But again, the cost of production, Chris, to me, is not the reason to be investing into silver and gold. It's due to the problems with energy destroying the value of most assets going forward, and the market waking up to that and getting into precious metals to protect wealth.
Well, I hear you, and I think that's why a lot of people have turned there, and certainly it's been perhaps a longer journey than many have expected, especially as we watch things unravel and prices going up and not making life easy for many people out there. But fortunately, we have people like you on our side who are digging through these things and helping to connect the dots. So, Steve, sure appreciate everything you shared there. And perhaps before we wrap up, you could just let folks know where they can find your research on the web.
Chris, thanks so much. And maybe in a few months, in the winter, I think we could see some fireworks in the winter with the energy, especially in Europe. I run the SRSRockReport.com website. I've got some free content. We have the silver and gold members where I spend a lot of time putting out the details of how this is all changing. So we understand that the peak oil is a real thing, especially now, and the numbers don't lie. And then there's the energy return on investment, which really proves the problem that we're facing. And so I've just changed how I look at the metals. I have always believed in the precious metals, but now I understand the 2,500 years of the common sense reason to be invested in them. Unfortunately, 99% of the market forgot about it. Because back in the ancient times, and even up to the 18th and 19th century, the market understood the foundation of why we should own precious metals. But when we brought this wonderful oil on, and we got into all these imaginary assets that are based upon energy production growth, we forgot why we need to be in the metals. And the world is for a rude awakening. And when the rubber hits the road, they're going to relearn why it's important to protect wealth in the future. So thanks again, Chris.
Well, thank you, Steve. I sure appreciate that. And again, it's good that we have smart folks like you out there digging into these things, and just good to hear your voice again. And we'll have to catch up and do this again soon.
That sounds great, but I'm not really smart. And the one thing I realized what to do is learn who to listen to and who not to. And you don't have to be too smart to figure that one out, because if you learn who not to listen to, then you're open-minded to figure out who to listen to. And I think that was the biggest thing for me to understand.
Well, certainly having good teachers is a big part of that. And it seems like you've done pretty well there, and just appreciate you coming on today and sharing everything that you've learned and taken a step further on your own today with the audience. Think people will find this helpful, and we'll have to do it again soon.
Thank you, Chris.
Well, thank you, Steve. Sure appreciate you joining me, and hope everyone at home found that helpful. Certainly with everything going on in the energy markets, I thought it was a good time to catch up with Steve and have him mix in how he sees that impacting the silver world. So a lot happening there. But again, hopefully you found this call helpful. Before we wrap up, for some of our BlackRock silver shareholders, did have some exciting news out yesterday as they continued their drilling results at Tonopah West and had a drill result of 6,526 grams per ton silver equivalent, which was 0.91 meters of 37.86 grams per ton gold and 2,740 grams per ton silver, within 1.52 meters, grading 22.88 grams per ton gold and 1,654 grams per ton silver. That's for 39.42 grams per ton silver equivalent. Additionally, they did continue to expand the Denver vein, going a full 1.6 kilometers northwest of the DPB resource area. And as you can see here, 1.7 grams per ton gold and 0.1 gram per ton silver for a 171 grams per ton silver equivalent, although that will allow them a follow-up core drill hole, which is planned to target for higher grades at more favorable elevation. And as Andrew Pollard of BlackRock mentions, our exploration model, which continues to be validated, indicates that this structure remains wide open to the west, where we have an additional 1,600 meters of strike potential to our consolidated property. It's clear that the project also has deep roots and remains open at depth, as we've yet to find the bottom of the mineralized system. And you can see on the map here is that hole that we were talking about with the 170 grams per ton silver. And they do have all of this area out to the west there, which they will be continuing to explore. So certainly some exciting news for BlackRock Silver. Exciting to see that things are continuing on well with their drilling, and also appreciate their support of the show and bringing you today's episode. You can find out more about those results by clicking on the link in the description field below. And with that said, we're going to wrap up for today, but we'll see you again tomorrow with Denver Dave's bi-monthly silver report.